The market's down just 30 points. I mean, I have to start with that. It's recovered massively from the lows. 17,389 is where we are at. This is the bounce which we were talking about. I mean, from the word go this morning. It's here, and it looks like for now it's staying. We'll track this one closely. Now, it's been raining new listings in the past few months, and a whole lot of new age companies have arrived in the street. A key talking point for these players has been sky-high valuations. The Paytm listing disaster has further intensified this conversation. How do you value these new businesses? What is the difference in the public and private market approach? And what is the likely wider impact? We put all these questions to our guests today who are joining us. Karthik Reddy is co-founder and managing partner of Blume Ventures. And he's also Vice Chairman of Indian Private Equity and Venture Capital Association. We also have with us Sudhir Variyar, Managing Director at Multiples Alternate Asset Management. Gentlemen, great to have both of you here with us, Karthik and Sudhir. Appreciate your time. I want to start with what's on everyone's mind, which is, of course, Paytm, and then we'll get into, the wider implications of it as far as new age businesses coming to public markets go. Karthik, let me begin with you. Was the pricing of for Paytm was that the problem, or it's more sort of is it a problem with understanding the business model? What's your own sense?
So I'm not a stated expert in public markets. I, in fact, sit in the other extreme as an early stage investor. I'm a seed investor, so a long way from public markets. Learning as our companies grow bigger, learning from what the American and Chinese markets have taught us about how to value long-term technology businesses, not for multiples of not the traditional DCF model and cash flows in the immediate short term, what their potential could be over an 8-10 year period. So I think every company, not just Paytm, all the four you showed there and more, are stellar examples of market leadership and redefining the market segments that they're playing in, right? So building new business models, new businesses for the long term. And so I think you're right. Paytm, I think, is the least understood in terms of what its business potential could be. The others are relatively more, straightforward in terms of the customer problem that they're solving, the growth that they're showing, and I think it's more of an understanding in the short to medium term of what Paytm could become that has set people on a nervous path relative to the other companies. Because ironically, the other companies were far less valued in the private domain as in the public domain.
Sudhir Variyar is also with us. Sudhir, hi, good morning. I wanted your thoughts here. The Paytm listing has sort of opened up a can of worms of high valuations, large losses, and a competitive landscape that could perhaps restrict growth, which is not only the case with Paytm, but many other businesses in this space. What do you think this means for the entire ecosystem? Do you think that the listings in future could perhaps not take place, or there could be some change in the valuation metrics? What is your takeaway from the Paytm fiasco?
I guess in any public issue, as you do more IPOs, etc., you would realize that the range and amplitude of investor types that you see in the public market is very different. Often people enter based on there are fundamental oriented investors, there are momentum oriented investors, there are programmatic investors, there are speculative investors. And in a very active IPO market where you are used to seeing IPO pops, you see a lot of speculative investors come in as well. And at the first sign of nervousness, there is obviously the swing to the other side is also very extreme. So these are events, I guess, one would kind of expect in any active IPO market. There would be some IPOs which will underperform. But overall, I still don't see a situation. And if there are, to kind of take your answer forward, if there are a couple of more situations where there is drops in IPO, post-IPO prices, then you would see the speculative interest go away and there would be more fundamental oriented investors coming in, which will correct the pricing a little bit. But I would still say that the kind of demand that is there in the market for good quality companies with good macros, good management, with a unique business model is very strong yet. So I don't see IPO activity come down. Yes, there is a certain segment of investors. And to answer your question about understanding of business model, this segment of speculative investors who come in because expecting an IPO pop is also not one which really spends time trying to understand the business model. This is a model which kind of says that they take a call on the kind of momentum, liquidity which is there, and therefore invest into it, often sometimes taking leverage and so on. So it's a very different market segment, and that is the one which will be very conscious about what is the post-IPO price. The more fundamental investors would take a longer term view, wait for more stabilization, see how management is delivering.
I guess the counter argument to that could be that it is the same market and the same span of time in which PB Fintech listed, in which Nykaa listed, same ecosystem of public market investors who could perhaps give a little more elbow room to these businesses. That's a separate debate. I have a question for both of you gentlemen. See, the problem of not understanding the business model, I guess that's an easier problem to fix. That's a function of communicating, right? The larger question, and I want your take on this, is the Paytm saga raising a larger question that the public market is not a space to bring businesses in when the path to profitability or the business model itself is not very, very clear. Karthik, your thoughts. Do you think that what happened with Paytm is such an emphatic statement that the public market standing up here and saying, hey, if your path to profitability isn't very clear and your valuations are sky high, we aren't ready for you, stay private?
In all humility, I feel public markets are a place where people do lean on established benchmarks on how to value companies. And so if you don't have benchmarks, it is going to be challenging. And for the first time, I was delighted to see all these businesses take on the challenge and actually go to the markets because they don't have benchmarks in the market. Even for a Zomato or Nykaa and Policy Bazaar, it's not easy to say that there is a clear validation of what has been achieved before. The age of shifting to these long-term technology-winning models, something that Amazon started, say, 20 years ago, showing the possibility of how much market share the organizing of such markets can create for these new business models is something that we're just about beginning to learn in India, in the Indian context, right? Conventional models don't even justify the other three valuations out there. So I feel there is the quantum of institutional support and the quality of institutional support for these stocks as they try to discover their price is going to be very, very critical. There are enough buyers who showed interest in the pre-IPO. They're not less intelligent people than the market as a whole. They constitute the market, 50, 60, 70 people. Institutions came and bought in those early days. And I think they will eventually make a judgment call on whether this is a hold for 2-3 years and they see value accretion from here, or they don't, right? And yes, there will be short-term blips and movements, but I think the understanding and formulating of how you should value such a business is being discovered in the public domain for the first time, which is a fascinatingly interesting time for Indian tech companies. But to your point, I think you're right. There is a lot more education to be done to this institutional base and to the market on the path to profitability or how to value these businesses. And I think investor relations roles take on far more seriousness than simply just reporting numbers in the context of that. And I think the narrative coming from the company has to convince the investors that this is long-term going to be a $30 billion or $40 billion company if you're listing at 20.
Karthik,
right?
let me quickly, because we're very short on time, let me quickly get Sudhir's take on this as well. Sudhir, is this a larger verdict on price discovery in the public market and what it is ready for? Or do you think what happened with Paytm is just a Paytm-specific issue?
I think if you look at the longer trend, there are a lot more investors coming in who are able to take on, very high quality investors who are coming in and saying that it is not just profitability that we look at, but the kind of moats that you build, market leadership, path to profitability, and I guess to a certain extent predictability. And these are wise investors and they add depth to the capital markets. And my sense is that these investors are only going to increase. So I don't see this as a verdict that these companies should not have come to the capital market, say, unless a lot more things gets proven. I think even proving the business model is a journey. There is a point at which you start kind of doing profitability at a certain level and then at a certain other level. And I guess it is good that there is more institutional support coming in, which are able to look at companies which are much younger, because the sizes and scale of these companies are also very large. They need much larger amount of capital, and public markets is the right space to raise the kind of capital required to ensure that these companies grow to its full potential.
Right. Just one question to both of you. Karthik, I mean, if you can, one difference, should we look at the cost of capital for private market investors? Most of these sort of companies are funded at the end of the day by large global funds, for whom cost of capital is pretty low. So they are, in a way, able to look beyond the, they're able to extend their view as far as path to profitability is concerned, right, till they achieve scale, which is not the case. I mean, the cost of capital is not what the cost of here is not what it is, primarily in the West. Is that a big difference in treatment, valuation treatment in private and public markets? A quick view, Karthik.
I disagree a little, because I think what we experience, at least in venture and private equity, you're benchmarked against the best in the world. I don't think technology companies, whether they're in the public or private space, are being viewed as conveniently being, an Indian market play or an American market play. Because the risk that is seen, or the growth potential that is seen, as being benchmarked against the very best in the world. So someone could be in Instacart in the US versus Zomato in India, or someone could be in the top British company versus Paytm, right? So I think the investor set is incredibly universal in that sense. So I think the cost of capital has become uniform now across the world.
Right. Okay. No, I mean, cost of capital is not uniform, right? I mean, if what you can borrow money in the West and what your cost of funding here in India is vastly different. I mean, still, there's a big difference.
In terms of return expectations of
source capital,
underlying investors' return expectations are about the same.
Yes.
So when I get benchmarked as a private investor, my benchmark is the same as the best US VC. I've been told that to my face, right? They're outperforming me. It's not about because they have a lower cost of capital, they're outperforming in India. The American VCs are outperforming us in a hot market. That's all I'm trying to say. So their public market expectations are about the same. So I'm just saying our benchmarks of the institutional investors who buy in, whether it's VC, private equity, or public market investors in tech, is uniform in terms of asset choices that they have in the US market versus India. I don't think they look at India as someone to whom they have to be lenient. That's all. Bar is high.
Sudhir, very briefly, just respond to that. Do you agree with Karthik, or you have a different view?
Yeah, I agree with Karthik, and to just expand that a little bit, even in the public market, there is no one cost of capital, right? When you are discounting an Infosys, you have a different return expectation vis-a-vis when you're investing in a Paytm or a Nykaa. And to that extent, it is not just a cost of capital argument. I would agree with Karthik that the return expectations of these investors, I guess, and it kind of at stage it decreases. So when you're looking at an early stage, you would expect a higher return. When you're looking at a more mature company, it would be different. And many of these companies which are going IPO, which are say pre-profitability, path to profitability, I would expect that the return expectations of these investors are also fairly high. It's not that they are a low return expectations.
Okay. All right, gentlemen, interesting debate, lots of views. Thank you very much for joining in and, joining in on this debate on private